Let's get this recording. We've got a few folks on. I know we have some folks who were signed up who will watch this on the replay. So if you are watching this later on, should you get the recording sent to you in email and you have any questions at all, please just ask. So if you're new to purchasing a home or have not purchased a home in the last 5 to 7 years, we're in just such a unique space right now that a lot of the things that we thought mattered when it came to purchasing a home just don't. A lot of people who were in a really great spot financially, had great credit scores, had low debt when they purchased their first home and maybe want to buy a home now. The cost of bread and eggs and gas and everything has gone up so much that debt is higher than it's ever been before. And people, they're just telling stories. I feel like you've got this idea in your head what I can do, what I can't do. So we're gonna kind of go over the do's, don'ts, and all the data that you need to succeed. If you are new here, if you've never seen me speak, my name's Ashley. I've been in the mortgage industry for 19 years. I'm a big data person as well. And kind of where I like to start whenever I talk to anyone, before we dive into numbers and where do you work, unless you obviously know, hey, I just had a foreclosure last year. Hey, I just had a repossession last month. What do I do? If you think there's a possibility of possibly being able to purchase a home, let's dive in and figure out, where are you at right now? What does your current dream home look like? Dreams do evolve. What you want at 29 is not the same thing that you want at 39 and 49. When you're a little bit younger and maybe don't have kids, that's when maybe you do some of the riskier things where you buy in the neighborhood that doesn't have the greatest school district, you buy a duplex so that you can have a rental property for your future. Versus when you've got older kids who are established in sports and in schools, and specific high schools matter, not just school districts. That's when we have different conversations about being in very specific neighborhoods and what does that look like. When we look at what you actually want, and what that can look like is literally grabbing a Redfin. I love Redfin. I love Redfin for the data. Do not ever give your information there, just like a realtor.com or a Zillow. They're going to sell your information to realtors that advertise with them or that work for them. But I love just being able to see, okay, this is a home in an area I like. It looks like what I want. It's in a school district that I want, or it's close to work, close to a freeway. This would meet my current and future expected needs. Once we kind of start there, we can figure out, what does it take to get there? Versus, I feel like if you just go in and you just look at the numbers, a lot of people will settle. I was listening to a real estate seminar about a week ago, and the person speaking said, in his experience, which this is his experience, but he felt like 90% of people who purchase a home purchase the wrong home because they're settling, or because they don't ask the right questions, because maybe they don't have someone guiding them to the right kind of mortgage product, to the right home, to the right neighborhood, to step back and look at things in a way that maybe can help them see big picture. So really, real estate is about your future. I know even when I purchased a home, it's stressful. I've purchased like 6 or 7 homes at this point, plus rentals. We've built new construction, we've renovated houses. It still is a stressful situation, and it takes a lot to really step back. So what we want to do is look at your financial picture and see how purchasing a home can help you, depending on what your goals are. If you have children, if you've got family members you're going to need to support in the future, there are so many ways that purchasing a home can change your financial future for the better if you really plan. If you have any questions, if you want to schedule, there'll be QR codes throughout. You can go to ashleywillardmortgage.com and you can click the contact me, and there's a link to schedule as well. But you can scan this QR code and you can schedule a 20-minute consult. It's free. You can send me an email if you have any questions as well, and we can kind of go over your specific situation, and it'll largely be like what we're talking about right now. So for me, I've helped almost 1,000 homeowners in total purchase and refinance their homes since 2007. My big why is that I was in this industry in 2007 and graduated college and immediately got to work at a big bank. And my first experience purchasing a home in 2009 was horrendous. I knew what to expect, but because it was a bank, it was not a mortgage broker. They had a lot of extra requirements. They had They're called overlays. And the loan officer, I did not get to choose who I worked with because I was an employee of the bank. They just gave me this person. And I fought tooth and nail to buy our first home. My loan was declined, I don't even know, 7 times. And I was the one that had to overcome it. My loan officer just kept giving up because he did not know the guidelines. It was an FHA loan. He did not know the guidelines. He did not know condos. He did not know insurance. He did not really know anything when it came to purchasing my home. So that experience completely shaped who I am today. It shaped why I'm passionate about purchasing homes, about the way that you purchase a home, about where you purchase a home, about the education that you get there. There are so many things, even to this day, that we're not required to tell you, especially regarding property taxes. I feel like if you talk to anyone about purchasing a home and you say, hey, were you surprised by your property taxes? I would say 7 out of 10 people would go, oh, yeah, my impound account, which is a savings account for taxes and insurance, it went up so much after a year or two. And they told me that there was no way for them to know that it was going to happen. Things like that are still to this day a situation when it comes to purchasing a home. And we can do better. We can actually go to the county records and we can figure out what those numbers are going to be if you work with someone who's not lazy. But there are still a lot of people who do the absolute bare minimum. They collect their paycheck and they move on. So I still love working with first-time home buyers. I especially love working with people who are going to dig in. There are so many programs out there. If you're a veteran or if you're active duty military, if you're a first-time home buyer and you have some gift funds from family or from a 401k, if you need down payment assistance, if you're looking to maybe sell a home and maybe buy a rental, if you're self-employed, but maybe you don't want to declare a lot of income on your taxes, we're not the IRS police. If you are willing to put in the work, we have so many options. Now, there are some people, and I get this conversation all the time. Why are you asking for that? No one should care about that. Well, mortgages for the most part are government backed. They get put into these big investment accounts called mortgage backed securities, and they're bundled and they're sold to investors. So people do care. They want to make sure that you're going to repay this loan. If you're willing to put in the work, we can look at all of the options. We can look at down payment assistance. We can look at possible tax credits. We can look at, I just was taking a phone call today about putting solar onto your home when you purchase it and financing the entire thing so that you own the solar system. Sounds like solar system. The system of solar on your roof. Things that never existed 5, 6, 7 years ago now are readily available if you're willing to look at all the options. And that's my passion. I want to look at all those options. So when we're starting to talk, my first thing I always start, what does your dream home look like? Where are you looking? If you looked on Redfin, I want to know because I want to know, number one, I want to know that county. I want to be able to pull the property taxes for that specific home. And I want to be able to dial in and say, how do we get you where you're going to go? But the absolute first thing that comes up is payment shock. So we have so many of y'all who are renting who have been in your home a long time. And when you've been in your home a long time, the landlord who owns the home bought the house at such a low price when rates were a little bit lower. Their payment is so low. Their taxes are low. So when you're paying a low mortgage, a low rent that covers their mortgage, 1650, 1750, 1850. I still see so many people who are paying under $2,000 a month for rent. I have family members included, where realistically speaking, if you were to look at the market rent payments, you would not be there. So I always tell people, let's go to a Zillow rent, like the Zillow rentals website. It's really helpful. Again, do not put your contact info in there because they're just going to sell it to a realtor who advertises with them. We want to see. I was looking at a scenario today. Their rent payment was about $17.50 a month, but they've been in the rental for almost a decade. And if their landlord were to decide to sell the property or they wanted to move back into that property, they would be looking at between $2,500 and $3,000 for a really conservative rent payment. And in this case, their landlord is probably looking to move back into the property within 24 months. So this is a real situation for them. So if you're looking and you go, man, my payment is going to go up if I buy a home, it is. Absolutely, because the difference between rent and mortgage is just, it's a figure that has never been this broad. However, if you're looking at market rents, it's not as big of a difference. If you're looking at a 2,500 square foot home on a market rental for renting it versus a 3,500 square foot home, it's not as large of a figure as maybe, hey, you've been renting for a decade. So if you have not yet checked out Zillow Rentals and seen what you would actually be stuck with if you were renting a home today, do it. I feel like it helps ease that payment shock a lot. Now, the other thing that comes up, and I'm a numbers person, but cars. You guys have bought and sold cars how many times over the last 15, 20 years? A lot, I'm sure. And when you go into a car dealership and they're talking payments, they're talking about, hey, why don't you go and put down an extra $400 or $2,000 and it's going to change your payment 40 bucks. And you go, okay, yeah, I can do that. That is not like purchasing a home. So an amortization schedule is the way a payment's divided up. And here's an example. If you're purchasing a $50,000 car at say 8% versus a $40,000 car at 8%, the monthly payment difference is $200, $202, $811 per month versus $1,013 per month. That's a big number because you're only paying that off over 5 years. So you have to be making big payments towards the principal, towards paying down the actual loan. You can't have a majority of it going to interest. Otherwise, you would never be paying that the car loan off. However, if you're looking at a house loan, $10,000 over 30 years is a $63 payment change. So when we start talking numbers, a lot of people, their only point of reference is really a car loan, and they go, this doesn't make sense. So a $500,000 loan, for example, at say 6.5% interest is kind of a good medium, middle of the road number right now. You're looking at $3,160 for principal and interest, just paying back the loan that doesn't include any property taxes or insurance, versus $3,097. That's $63 difference for $10,000. The reason that also matters is because if you were looking at a $100,000 purchase price, if you said, I want to go from $400,000 purchase price to $500,000 purchase price, that's going to change your payment around $630 per month. Consequently, if you have a car loan at $630 per month, and maybe it's just like a $20,000 car loan, that $20,000 car loan with that $630 per month payment, that's going to change how much you qualify for on a house by $100,000. So I know those are big numbers. We don't really have to dive into them, but when we start looking at your own personal situation, we're really diving in and saying, how much do you owe? How much is the monthly payment? What are our options there? You don't want to make any changes. You don't want to refinance, apply for any new debt while you're in the process because it can impact your credit score negatively. But when we look at those numbers, it's just a completely different way of looking at them. If you were in the waiting room, you saw this pop up. The biggest things with purchasing a home is that there's a lot of information that's going to be public record. So the number one thing that's public record when you're buying a home is when we pull your credit report. Now, as of the last 30 days, this has changed quite a bit, and you're not supposed to be harassed as much, but until all the federal entities really start cracking down, there is still a lot of harassment that happens. So there is a federal opt-out link. It's optoutprescreen.com. It is done by the 3 bureaus plus one other that's not as common. You can scan the code or you can go to optoutprescreen.com. You're going to scroll to the bottom. You're going to click to opt out and you're going to do the electronic opt out. I think it gives you a 5-year opt out. You can also do a permanent opt out if you mail it in, but do the electronic one. It gets started in like a week or so. If you don't do this over the last like 12 to 18 months and we pull your credit report, you could potentially get 200 phone calls immediately. Phone calls, texts, even if we don't include any of your cell phone number, anything, and most of us don't, they're skip tracing, they're finding you. You know, you can Google, you ever watch like Catfish, they find you. The other hard part is that they come in and they say, they can see who's pulled your credit report. They can say, oh, I work with Ashley at Edge. Hey, I'm going to move forward on this with you. Their goal, some people might be scamming you. Some people might just be trying to get a mortgage from you. Tricking you, getting applications. It's kind of a weird thing. It has been limited over the last 30 days, but it is still a thing. You can opt out. The other thing with protecting your data, and I just got this question yesterday, was kind of a question slash frustration. It was like, I just don't even know where to start sometimes because I'm so scared about being scammed. And it was really frustrating to me because I couldn't say, no, you're not going to get scammed, because there are people out there trying to scam you. So what I can say is that once you know that you're working with someone, please get their cell phone number, save it in there. My cell phone number's been the same for a million years. It'll be on all the papers that you have, all the websites that you see me on. You can save it as Ashley Willard, mortgage broker, whatever you want to save it as. That way, if there's ever a question about, hey, did you send this? Did your team send this? You can call me, you can text me directly. So while you're purchasing a home, the biggest fraud is, number one, selling your credit report data that you've applied for a mortgage. They basically just say, hey, this person wants a mortgage, let's harass them. Once you've closed on the home, the biggest difference is that you're going to start getting a lot of stuff. And a lot of it's actually by mail. So there's going to be stuff that looks really like papers that look really official that will say like deed recording, $59 to record your deed. Well, you don't have to pay for any of that. That's done when you purchase the home. But they're trying to sell you things. And in like really tiny fonts, it'll be at the bottom saying like, this is not a government entity. There will be lots of stuff when you purchase a home because you purchasing a home is now public record. Usually how much you purchased it for, sometimes your name, depending on the county and the state, if they allow that to be public record. In Florida, it's really everything is public record. Very odd. Same thing with Texas. California, it's less so. You're going to get like the solar people. You're going to get water delivery. You're going to get gardeners. You're going to get pool maintenance. Anything. I mean, you're going to get the organizer. Hey, do you want to epoxy your garage floor? Those are things people are going to know. Hey, you purchased a home. If you ever have questions about them, please ask. There's really only one thing that you need to pay attention to after closing, and that's going to be from the county for your property taxes. Your property taxes will be one thing based on what the current owner, the previous seller, the person who's selling you the home, what they paid for, and then you're going to get a supplemental tax bill to bridge what your new payment will be. And we will have already gone over what that should look like. And that's really the only thing that you need, but you'll get inundated. And the best way is just to always verify, always ask questions. There are a lot of myths, and some of them were not really myths. If you've purchased a home or tried to purchase a home in the last 5 to 7 years, there were just a lot of overlays. There were a lot of extra restrictions on purchasing a home that really have been removed. For a while, we had just a couple of investors out. We had some big mortgage investors, we had some big banks, and that was really all the big players in purchasing a home. We sold loans directly to the government, either FHA or VA would buy them. Fannie Mae or Freddie Mac are the conventional home loan purchasers. And it was very black and white. For a long time, I could look at anyone and I could say 36.99% is exactly what I can qualify you for on a house payment based on your income. 1,000%. Like I know that number 1,000%. Now it's not like that. Now it's a much more of a big picture thing, which is, it's frustrating because it's not black and white, but it's also so much more available than it's ever been before. So it used to be, hey, I need 20% down. And for a long time, 5, 10, 15, 20% down were really the biggest options. FHA loans are very readily acceptable now. Sellers don't usually have an issue accepting them unless there's something health and safety wrong with the home, or there's peeling paint, or obviously mold or stains on the ceiling, things like that. FHA loans and conventional regular mortgages, they could potentially put down to 3.5% to 5% down. The other things is that you may be able to put down a little bit more money to offset something wrong with your credit report. So it used to be that you needed a 640 credit score. Maybe we could get you at like a 620, maybe 618, we could squeak something out. It was really difficult there for a while to be below 640, maybe be above 600, but they were gnarly. The entire package. I mean, we used to have to do paper packages. It was thick what we had to go through. Now it's a lot more accessible to get loans at lower credit scores. We have combination of, hey, I have savings, I've got IRA, I've got gift money from family, 401ks, I'm self-employed, but I
don't declare income on my taxes, but I can show it on my business bank statements, whatever it may be. If you have something wrong with your credit profile, or if you're not showing enough income on your taxes, we may be able to overcome that by showing, hey, we have compensating factors. We have other things that are strong. We've been paying rent at a high number and we can verify it for 12 months. We've been paying these other debts, or hey, I had an extenuating circumstance. I had a death in the family. I had a divorce where we were supposed to be paying this half and half, and one person just decided not to pay anymore and they trashed my credit on purpose. We can have those conversations now and really overcome them and help you get into a house. The other thing all the time, and usually this comes up when people have never purchased a home and they just go, I just want the lowest rate. What is your rates today? And I go, well, on any given day, there's going to be like 20 different interest rates for every loan program. Sometimes if you're buying like a down payment assistance, that will be public record. You can see it on the county websites, the state websites, whatever program it is. Otherwise, we can look at all the options. There's going to be times where you go, hey, I want to pay extra to get a lower interest rate. And we look at all of those options. That's called buying down the rate. And then there's people who say, I am putting every penny I have into the down payment. I need help. And they'll actually look at taking a higher interest rate in exchange for a credit to pay for some of their closing costs. So there's 20 different interest rates at 30, 40 interest rates on any given day for any program, and choosing the one that will make the most sense for you is really only possible once you're in contract, once you've agreed to a purchase price with the seller on a specific home. In the meantime, we get you as kind of like a good idea, a good range, but it just kind of varies. So there's three main loan types. We've got FHA loans. That's going to be great for lower credit score, lower down payment buyers. The benefit for FHA loans is that they don't penalize you for a lower credit score. They are going to give every single person the same amount of mortgage insurance. You'll pay the same amount of extra insurance on the loan, basically against default, to help the lenders secure them against default, whether you have a 520 credit score or a 720 credit score. The FHA loans, usually you're not going to be in them forever because mortgage insurance, that extra insurance, is there for the life of the loan for pretty much everyone. And eventually you're going to have the values go up and you may want to refinance out of them, or as your credit score gets better, etc. But as far as the starting point, FHA loans are going to be the most lenient. VA loans are also very lenient when it comes to credit score, when it comes to debt, especially when you've got BAH and BAS pay, if you've got any other non-taxable pay. VA really looks at your overall picture. They do look at some unique things like how much the utility is going to be, but then they also see how much are you getting that is not being calculated from the government for taxes as well. And then conventional. If you are looking and you say, hey, my credit's good to great, I've got a down payment in my 401k, I'm getting gift funds, I want to purchase a single family home or an investment property, a regular conventional loan is great. It's going to have some PMI, private mortgage insurance, that can go away once the home is worth like 22% more than what you owe, or if you put 20% down up front. The conventional loan is going to be very strongly based on your credit score, your debt, and your down payment. So if that's all in the great situation area, then that can be an option as well. The biggest reason to look at conventional loans, even if you don't have great credit, is in states like California, Texas, and then all the other ones that are on the bottom: Washington, Wisconsin, New Mexico, Nevada, Louisiana, Idaho, and Arizona. Those are what we call community property states. And in those states, even if you have a spouse with good income, if they have very high debt, we have to count their debts against you for purchasing the home, whether or not they're on the loan. Now, sometimes we can use their income, sometimes we can't. Sometimes their income's not enough to even offset their debt. We have to really look at the big picture. So that's a big thing. Also, we have a lot of people who are not legally married. We have a lot of communities, we have a lot of nationalities that get culturally married. We ask questions very specific about those. Are you culturally married or legally married? Because in states like California and Texas, it really matters. When we're doing a loan, we're really just telling a story. We start by going back a minimum over 24 months. Where have you worked? What's the name of your employer, the address, what kind of hours have you worked? We're going to get at minimum 30 days of pay stubs, your last 2 W-2s. If you have anything unique where you don't get paid a salary or you don't get paid exactly 40 hours per week, if your pay ever varies, then we may ask for, we can go to your employer and we can get this as well, but it can take weeks. Or we may ask you for the final pay stub for the last 2 years so that we can really see what your breakdown of pay looks like. If you have alimony and child support and you want to use it, we will have to look at divorce decrees. If you pay alimony and child support, we have to count that against you. And we have to get those divorce decrees. There are bank statements that we're going to need with all the pages. So all the time, I don't even know. Now you get the PDF and it just downloads it, and still people remove the last page. It's going to say, hey, this page was left blank for that last page. We need to see 2 months of all of your asset statements. These are kind of the standard requirements: 30 days of pay stubs, 2 W-2s, 2 months bank statements, driver's license. That's where we start. If there's extra things that we need to show, hey, we've got a lower credit score and we're trying to overcome that, we can use verification of rent. We can show 12 months of canceled checks from rent if you paid check, 12 months of like Zelle, or 12 months of bill pay, or if you rent from a property manager, we can show 12 months of history from them. If you're renting from a private landlord and you pay sporadically, or sometimes it's via cash and sometimes via check, we can't use that. That's why we start to ask a little bit more open-ended questions up front. And when I say we, I mean me, and like the really good loan officers are going to dive into this. There's a lot of loan officers who just want to give you those easy answers. Yeah, everything looks great. And then eventually you get down the road, you waste weeks, months of your life, thousands of dollars on inspections and appraisal, and they blame it on someone else down the process in the loan process, the underwriter who approves it, that's going to say, oh no, you don't actually qualify. So the more questions we ask up front, the better. Like I was saying before, when we're looking at your income and debt, it's a kind of a percentage that we look at, but that percentage is such a moving target. Literally, what qualifies now might not qualify in 30 days. So kind of like a good number here, at $9,000 a month, if we validate that as income, we confirm that is actually the income, we would start off saying maybe around 45% of that can be spent on debt. Now, on some loan programs, based on credit score, it might be way less than that. On some loan programs with great credit score or more down payment, we might be able to be way higher than that. So for example, if someone, a husband and wife making $9,000 a month, if we were looking at 45% as like a baseline starting, we would be able to spend about $4,050 per month on all debts. If they have an $800 car payment, $250 in student loans, and $100 in minimum payments on their credit cards, now I'm left with $2,900 they can put towards a home. So at this point we go, does $2,900 get you that dream home, what you wanted? And a dream home can be something different for everyone. A dream home, you're starting over, you're going through a divorce, and you're moving out for the first time. That dream home could just be a really cute townhome as close as possible to keep your kids near family, near their friends. That is a dream. It could be a ranch up in the mountains. It could be a single family with, a detached second opening because you've now got to take care of a family member and you really need a bedroom downstairs and you need their own access point. Like a dream home does not have to be some mansion overlooking the, ocean at $20 million. A dream home is just whatever meets your current and future needs. So does $2,900 in this situation get them towards their dream home? If it does not, we need to step back and go, okay, where do we need to be? Where are we looking at? The car payment, we may have options to refinance it to get a lower payment. Now we have to be very careful. We don't want to apply for any credit while we're purchasing a home because that can, number one, lower your credit score. And then number two, a new loan on your account because it's brand new essentially and your balance is the starting point. It kind of looks like a maxed out account. That can hurt your credit score as well. But if it turns out that qualifying with a lower monthly payment is an option, we can do that through the process with you. We can say, hey, I called this credit union next to you. They can get that payment down to $450. Here's how to do this. Here's when you're going to apply. Here's how you're going to apply. Here's what you're going to get from them. Here's what you're going to send to me. It's going to be very specific. You don't just go willy-nilly, hey, talk to you over the weekend. I just went and applied for a new car payment. I got one. Like, don't do that. Student loans, these are the biggest ones because we've had so many people with COVID forbearances not paying on them, or they came due and were not alerted that they were coming due. So even if you have zero payment on your student loans, we may have to qualify you with a payment. So the biggest thing, if you have no payment showing on your credit for student loans, you need to call and find out what the IBRP, the income-based repayment plan, would be. Because there are some instances where we can use that figure. And if they say, hey, you've got $100,000 in student loans, on my payment, I've got to qualify you with 1% of that or 0.5% of that. So I've got to qualify you with $500 or $1,000 a month of a payment on that. If they say, hey, your income-based repayment plan is 217 or 417, anything lower than what I would actually have to use, then it's great. We can possibly look at using that depending on the scenarios. So student loans, obviously, those are just big numbers right now. We've got to dig in and see where those land. And then credit cards. A lot of people will say, I feel like probably 7 out of 10 people now will say, I can pay that credit card off, or I pay it off every month. Well, credit card minimum payments come based off of what's on the statement. So the credit card minimum payment is going to be based on the balance as of the last day of your statement. So if you know that you pay it off every month and this $100 a month is hurting you from qualifying, you need to just change the way you pay things. You can start paying your credit cards once a week. You can look and say, hey, my statement generates on the 17th of every month. I need to pay it in full by the 16th of that month. And you can even pay it in full and then pay a little bit extra. You want that balance to come at a zero balance, if possible, to help us with that. So when we're looking at these numbers, it's not just because here are the numbers. And unfortunately, there are a lot of people that will look at the numbers and say, you don't qualify, or here's all you qualify for. And they won't actually start asking questions. They're scared. They won't say, hey, do you have gift funds? We're in kind of a unique spot right now. We have a lot of family members, a lot of people in our lives who maybe purchased homes a long time ago and who have a lot of equity, who have a lot of value in them, or their investments have done really well. And we've got family members who are getting older, and you might hear them say like, hey, I've got a will, I've got a trust, and you're going to get money when I pass. There are a lot of hard conversations that we're starting to have right now, and we go, okay, all right, grandma, you're 80, you're probably going to be around for another 15 years. That extra 30,000, 50,000 you were thinking about leaving me, that's really not going to do me a lot of good in 15 years, but it would do all of the good right now to get me into a house, to get my family into the neighborhood that we want to be in. Obviously, it feels like a bit of a morbid conversation, but we're having a lot more conversations like that and just being like, what does that look like? What would it be like if you could see, instead of watching me struggle, if you could gift us this funds right now? Now, gifting funds sounds scary. There are a lot of great tax advisors that can give this to you. You can even ask Google. Gifting money is actually, there's no money. It's not a taxable thing. You don't owe extra taxes unless you're gifting a lot of money. It just basically goes towards the lifetime gift that you can give to a family member. So ask questions about it. I'm happy to pull up the IRS guidelines and show them to you. It's been interesting, but we've had a lot of family members step up recently and just go, okay, I get it. Purchasing a home now, it takes more cash, more capital than it ever has in the past. So big things of what not to do. A lot of these things sound so crazy. If you deposit cash into your bank account, even $1, it is like a big deal. If you deposit $1 or $5 or $1,000 into your bank account, I cannot use that money. Randomly, like if there's, hey, I sold gold and I have the receipt and I have proof that the gold was mine and I deposited the exact amount, maybe I can use the cash. But if this is cash from family or from under your bed, wherever you find it, I don't want to know, then I cannot use that money. Not only can I not use that money, but then you're going to be spending that money on bills. And now your balance is even lower. And so it kind of does this weird calculation where I'm like double hitting you for depositing cash. So if you have cash, let's talk, especially if you've got, a good chunk of cash. We need to figure out the best way to use that. A lot of the times it's going to look like, hey, I'm going to pay my utility bill and I'm going to go to them. And I'm going to say, here's $500 cash, pay my utility bill, pay my water bill. We don't want to pay rent in cash because that's a big deal, but you can go into the bank and you can deposit, you can pay cash on your credit cards. You can say, hey, Chase Bank, I wanted to pay my credit card down. Here's cash for that. Don't deposit to my bank account, just pay cash towards my credit card. Anyway, anytime that you would go and use your debit cards to go get Starbucks, to get whatever, pay cash for that. We can really look and see. Now, if you've got $100,000 in cash, it's a bigger number. We got to figure that out. Do not accept gifts from family. If you have family who says, hey, I want to give you a gift, amazing. Let's talk about it. Gifts are a great thing. They're also a little bit invasive. If a family member gives you a gift, it is so invasive to them. We've got to get so much proof that the money was in their account. It's really terrible. We can use a gift letter at closing and we can get the money from them in a specific way that is less invasive. Still requires paperwork. Credit. Oh man, there are so many people on Reels and TikTok right now saying that you should go ahead and dispute items on your credit report. It's going to improve your credit score. That is the case. It will improve your credit score, which is great for car loans, lines of credit, all the things, except for a home loan. Because a home loan looks at an automatic underwriting system that is going to look at those disputes and know that a dispute is masking, it's hiding what's on your credit score. It's saying that's not a real credit score because that dispute is not even letting me see how badly that negative item is affecting you. So do not dispute items. If you have a dispute, do not remove the dispute until we talk. Depending on how much you've disputed, how much the balance was, there are certain parameters, like if it's over 1,000 for this or over 2,000 for that. It is very specific. So don't start anything new, don't remove it. Do not close any credit cards or car loans. Closing a credit card and removing that available credit is a big deal. Closing a car loan, like say you're like, hey, I only have 2 months left on this payment for this car loan, I'm just going to pay it off. Do not do that. Usually, if we need to, we can pay it off at closing. We may be able to exclude it depending on what the actual payment amount is. But when you close the car loan, all of that positive credit history goes away. And if you have credit score that's teetering between like fair to good, that can be a kiss of death, basically. Do not apply for any new debt. Do not co-sign for anyone. I know it is so difficult. Family member asks you, hey, I need you to co-sign. Do not do it. Do not do it. It's really difficult to get co-signed anything excluded. There's possibilities for it, but it's very specific what it needs. And very rarely does it happen properly. There are a lot of ways that it can really mess you up. Do not miss any payments. A missed payment in the last 12 months is really a bad thing. Missed payments, before that, they hurt less and less and less. After it's been 36 months, it hurts a lot less. But a missed payment in the last 12 months is a really big deal. Career moves, do not switch jobs, do not change how you're paid. If you get the opportunity to work, instead of 40 hours a week, you can work 3/12s. Please don't do it. If you need to, we can talk about how to make it work. But there's a lot of documentation that we need from your employer to show basically they have to guarantee. They have to guarantee you X amount of hours, and they have to explain a lot of things. If they won't, and a lot of the times employers are really worried right now about using that word like you're guaranteed pay or guaranteed these hours, then we may have to average your pay over 12 or 24 months, and it really can help, like it can hurt you a lot. And the biggest thing, please don't listen to crazy advice. As soon as it's like, this is my example. You want to buy a red car. You think, man, I'm gonna buy a red car. And now everywhere you go, you start seeing red cars. So you want to buy a mortgage. You start asking questions about mortgages, Gmail, Chrome, Meta, everyone starts selling your information that you want you want mortgage advice, you want mortgage info. You get the reels, you get the TikToks, you get the advertisements, you get crazy advice. Apply for this, do this, buy this, don't do this. Oh my gosh, please don't do any of it. Now, what you should do is you should write it all down. Text it over, email it over, and be like, what is this? What does this mean? Should I or should I not do it? And a loan officer who is good at their craft, they're going to explain to you why something is good, why something is bad, why something doesn't matter, why something could be the kiss of death. But ask before you do something crazy, please. Please. Home buying is really a team sport. Right now, we have a lot of folks who they get in, they talk to a realtor first, and then they finally talk to a loan officer. And when we really start diving in, we go, oh, okay, We're in just a different area. It used to be that you could, like 2 years ago, you could talk to a realtor and maybe find that they were not like your cup of tea. Their schedule didn't work with yours, their knowledge base based on the area you wanted to go didn't work for yours. And you could say, hey, I want to find an expert. Well, now, because of some legislation that kind of came up with the National Association of Realtors, you have to sign a buyer broker agreement, a BBA, that says, I'm working with you. John Smith, I agree to work with you for 60 days, 90 days, 120 days, whatever. And I agree that you will get paid 2.5%, 3% on this transaction. Now, if the seller does not agree to pay that portion of the buyer fees, then you're on the hook for paying them. Unfortunately, because of just how the market has changed, sometimes you get roped into a buyer broker agreement and it may or may not be the best realtor for you. And sometimes it's more difficult to get out of those. So if you have not set up with a real estate team, let's chat. I love to go through and be like, all right, we've dialed in what your dream home, your dream area would be, and we're close. We can get you pretty dang close. Or maybe you can buy one of the older homes in that amazing neighborhood. What does that look like? From there, we can look at maybe realtors that are experts in that zip code or in that neighborhood. I was just talking to someone the other day. I was actually talking to a seller, and she said, I said, hey, have you talked about who you're going to list this home with? And she said, yeah, we're going to list it with so and so. And I said, you are listing in a really specific, unique area. It was an HOA that was between two cities. It was one school district next to another. I knew the area really well. And I said, there's really one person who dominates in that neighborhood. You can list with anyone who knows that neighborhood. And I said, look at this person. They've sold 20 homes in this immediate neighborhood in the last 12 months. And the person that you're looking at has sold, I think one, I think the number was one, maybe it was zero. And I said, obviously you have to make the decision for you. And there are some neighborhoods that you just go into and you just go, everyone's going to want to buy here. We've got some neighborhoods in North Florida, some parts of Texas, some parts of Northern California that you just go, this is a desirable area. Anyone who lists a home here is going to sell a home here because the entire neighborhood sells itself. And then there's some neighborhoods that you have to be an expert in. With that said, you need to find a good realtor who knows the area. I can definitely lead you. I can get you the exact data of what they've sold, what they've purchased, so we can make sure that you're looking at that from a perspective that's going to help you versus put you in a spot where they don't know the neighborhood and negotiations. On the lending side, it's going to be, generally speaking, me. I process a lot of my own loans. There are going to be certain loans that we have to bring in third parties for, especially down payment assistance. Construction loans, construction lending is more available than it's ever been. Once the loan leaves us, once you've found a home with your realtor, that's when we start bringing in all these extra people. The escrow company is a neutral third party that the seller, generally speaking, chooses. The escrow team is going to research the home, the buyer, you, and the seller. They're going to say, hey, does anyone have any judgments? Does anyone have any legal claims against them? Does the house have any legal claims against them? How much is owed on the house? Is the trash delinquent on the house? All of these things, and they're going to check it off. That's clear, that's clear, that's clear. They're going to give you insurance on that transaction to say, hey, you're purchasing this home. The title is clear. Your name is clear. We're not worried about anyone coming after buyer, seller, or the house. We're free to move forward. Home inspectors, you get to choose however many inspections you want to do. They're optional. Unless you're doing a VA loan, you probably want to do a pest. But if you want to have roof inspections, chimney inspections, pest inspections, pool inspections, sewer inspections, whatever it may be, you pay for those as a protection to know what's going on with the house. Homeowners insurance, that's one of those things where you dial in the numbers on your insurance once you're actually in contract. But if you have someone who is really great locally, especially, then you want to get them involved. We'll get them involved earlier on and just say, hey, we're looking at homes in this neighborhood. Based on this house that we're looking at, can you give me an idea of what the property taxes or what the home insurance would be? HOA, homeowners association. I've lived in an HOA for basically the last 20 years. But there are some HOAs that are different than others. There are some that will gouge you on getting the documents, like they want $1,000 for it. Those are all things where we have to work with third parties that are going to be part of the transaction because of either the buyer, the seller, or because of the property. And sometimes we just don't know about those things until you actually are in agreement with the seller to purchase a home. Once we have all that data, it goes to an underwriter. That's the person who's going to approve the loan based on the entire loan package. And hopefully nothing has changed. Hopefully there's no surprises. Hopefully you don't have any extra alimony or child support you didn't tell us about. You didn't buy a house or quit your job or sell your car or anything crazy that's going to change things. But there are a lot of people that kind of come into the mix. The escrow company is a big part of the transaction, but there's also an account called an escrow account. So this is something that will come up a lot. When you purchase a home, there's the escrow / title company. And in some areas, they also use an attorney, or they use an attorney in addition to them. They're going to be the neutral third party between you and the seller. They're going to hold your deposit. If you and the seller get into a fight, they don't release the money until everything's, agreed upon. They will give the money for the loan proceeds to the seller after they pay off their mortgage, all the things. They handle all that. You're also going to have an escrow / impound account for your property taxes, your homeowner's insurance, and mortgage insurance if you're not putting 20% down. The biggest thing with this is that they pay your loan, taxes, insurance, etc. when they come due. However, there are very little restrictions or oversight on the taxes and how they're calculated. So generally speaking, property taxes will be calculated at 1.25% of whatever you purchase the home at. But there are going to be certain areas. If you look around, I always tell people as they're kind of going from neighborhood to neighborhood, you have some neighborhoods where you look around and they're established, the trees are big, they've got electricity poles and the tower lines are visible, everything's great. The parks are established, they're shaded because there's lots of trees. Those property taxes are often going to be around that 1.25%, maybe even a little bit lower. If you're in an area like Texas or Florida, or in newer areas in California, and all of a sudden you start to say, hey, where did the electric lines go? And you go, oh, they're underground. Hey, that's a brand new library. That's a brand new school. That's a brand new park. That's all infrastructure. Those are all going to be things that are supplemental taxes, that are special assessments, that are Mello-Roos, that are CDD fees, depending on where you're looking at, they have different names. And what's important is that we figure out what those are going to be, because we don't have to. Legally, we can just say, here's your taxes based on 1.25% of the purchase price, which is so ridiculous. Whereas we can go to most counties and we have to dig. I was digging today on a house in Texas and I had to go through like 7 different screens to figure out which school district it was part of, what bond they were associated with. It was really a unique property. And at the end of the day, I was able to say, hey, we were expecting almost 3% property taxes in Texas, and this one's actually 1.9%. We're in a really good spot. But legally, we only have to calculate it at 1.25. So we want to know what that's going to be. The other biggest reason for that is so we can calculate that up front and we can be comfortable with that payment up front. Now, even with that said, when we calculate that for you, at some point in time, you're going to get a big refund usually. The county is going to say, hey, we don't want that money. They're still thinking that you're the previous seller, the taxes are low. They're going to tell your mortgage company, whoa, 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 you've got way too much money. We don't want any of that. Your mortgage company cuts you a big check. You get a check in the mail, 3-4 grand. You're like, woohoo, don't spend that money. From there, we look and we call the county. We go, hey, when is this supplemental tax bill? When are you going to realize that the taxes are higher between what the buyer bought it for and what the previous seller paid? Sometimes it's available online. They just never mailed you a thing, or they mailed it to you, but it looked like spam, so you threw it away. There are so many ways that we can prepare you for your payment not to go up, that it's really important. It's really it's a time-consuming process. And a lot of people, especially when you're comparing apples to apples, they'll go, I looked at Zillow and Zillow said my payment was going to be this. And I go, Zillow has your taxes completely wrong. I can do a Zoom with you and I can show you exactly why the county is telling me why this is going to be your taxes. But we have to have these honest conversations. There are a lot of people who want that easy conversation, and then they get these huge surprises later on, which like your payment could go up $200 or $300 a month if you're not careful. So out of pocket, the biggest things are your down payment. So say you buy a $500,000 home, you're looking at a down payment 3.5% to say 5% or more. A 5% down payment, that's $25,000. But what else is included? Closing costs are generally speaking like 7,500 to 10,000 is a good number. That's going to account for a year of homeowners insurance, like 2 to 6 months of taxes, depending on when they're due, HOA, the escrow and title company. The closing costs, you can ask the seller, especially if it's a home that's been sitting on the market for a while. If it's a less desirable home, you can say, hey, seller, will you give me 2, 3, 6% in some cases? There is a maximum depending on how much you're putting down and the loan type of what you can ask for, but you can ask for closing costs to pay for this. Buyer's agent commission, this used to just be paid for by the seller. In theory, there's a whole lawsuit that happened with it. Now you're going to have an agreement up front saying, hey, you will get paid X% based on any home that I show you. Now, if the home is already saying, hey, I'm going to pay you 2.5%, but you've agreed to pay 3% to the buyer's agent, there's a difference there. You can ask the seller to pay for that difference. You can ask for a closing cost credit to help cover that difference. You can pay that difference. It's a unique situation. There are many realtors who are really great about getting their compensation negotiated by the seller. There are some who are not, and we want to definitely put you in a spot where that's not going to be an issue. The upfront items, an inspection for the appraisal, it's usually $600 to $800. Now, in some areas where it's harder to find comps, it's harder to find comparable homes that have sold, it may be more. And then $400 to $1,000 is kind of a good number for inspections. You can have as many inspections as you want, as long as it's within the time period that is allowed between you and the seller. So generally speaking, you've got your down payment. I would estimate like $10,000 for closing costs, plus like $1,500 to $2,000 for inspection and appraisal. Those are kind of like 3 chunks of money. In the end, though, it kind of all goes into your total out of pocket. Inspections and appraisals can usually be paid for on credit cards, but the rest of it will be money that we verify, no cash deposits, etc. So those seller credits, gifts from family, 401k loans, you can take a loan against your 401k, and it does not hurt your debt, generally speaking. So especially if you're in a job where you feel like you're going to be there for a long time, because if you do quit the job, you've got to pay it in full or it becomes a taxable transaction. You can withdraw potentially up to 50% of your 401k as a loan. I say potentially because most employers will cap you at 50%, some will cap you below that. Those are really great options. There's down payment assistance, and there's lender credits, which are taking a little bit higher rate in exchange for paying some of these items. Now, down payment assistance is one of those things where you really can't have your cake and eat it too. There are going to be things that are offset. When you get down payment assistance, it's usually because you're a first-time home buyer, you haven't owned a home or been on the title of a house in the last 3 years, and we have to prove that. We've got to prove that with 3 years of taxes. We're going to be asking questions about anyone over the age of 18 who lives in your home, depending on the down payment assistance type that can come up. Lender credit, by taking a little bit higher rate to pay for things, you might go, why would I ever want to do that? Well, if it keeps an extra $3,000, $5,000, $10,000 in your bank account, you can do that and possibly look at refinancing when it makes sense, 6 months, a year, 2 years down the road, when the values and the rates align to put you in a better spot. So everything kind of upfront is like a slow process. What do we qualify for? What does it look like out there in the market? How am I going to make this offer on this home? Is there 10 of people making the offer? Has the home been sitting on the market for 60 days? Like, it's just kind of like slow. And then we go into warp speed. As soon as your offer is accepted on a home, within 3 days, you have to put your earnest money deposit, or the EMD. That's usually 1% of the home price or more. The higher the earnest money deposit, that's kind of your deposit you put, that will eventually go towards your down payment and closing costs as well, then the seller might think that you're a little bit more serious. So it's one of those things, 1% or $3,000 to $5,000 is reasonable. But if there are a lot of people who have interest in a home, you may say, okay, we're going to put a $10,000 or $20,000 earnest money deposit that you can potentially get back if the inspections come back poor. But that one tells the seller, hey, you're very serious. That's due within 3 days of getting your offer accepted. Within 1 to 3 days, we're literally running. We get on the phone, the escrow/title company gets assigned. I'm calling them. Hey, what are your fees? What's the county's fees? What do you need? What's your notary's fees? All of the things, right? They're going to do what's called an SOI, statement of information, to make sure that no one has any claims against you. There's no IRS debts, federal debts, liens, anything like that. They're running also. We are going to do our best to get all of the estimates from escrow, from title, from the appraiser upfront, and then we are going to disclose your loan. We're going to give you this package that says, hey, based on everything that we know about the home, here's your new payment. Here's what we expect to be out of pocket. Pay for your appraisal. You can put that on a credit card. And then within about 10 days, it's going to be whatever you agree on in your contract. So it could be like 7 days or 14. You're going to be getting that appraisal back. Unless it's really hard for the appraiser to get out there and get access to the property. That's another conversation. Any inspections you want to have done, you're rushing to get them done. It can feel like those first 10 days are just like your entire life is, I've got to be at this inspection, or the inspector is going to be there from 1 to 3, and then I've got to be there at 4 to meet them for the report. It's insane. Those first 10 days are insane. And then it gets so quiet. After that, we've kind of got things going on in the background. We're waiting for the IRS to confirm that your tax returns were filed if we need taxes, or that your W-2s were actually correct, that you didn't make fake pay stubs of W-2s. That happens. We're waiting for your employer to say, hey, she still works here. He still works here. He didn't quit his job. We're waiting for the inspections. You're saying, hey, the property's still good. I want to move forward. The appraiser comes in and says, hey, the property is as is. We don't have any repairs that are required for health and safety issues. The value is good. And then we put it all together. The underwriter is the person who's looking to approve it based on federal guidelines. And they tell us, hey, we need some weird thing. On your credit report in 2007, the address in Montana came up and someone foreclosed on that home. Can you provide a letter of explanation that you, Jane Smith, did not have ownership of this random Montana house that foreclosed in 2007? The most crazy stuff comes up, let me tell you. And we do try to get ahead of that. We go through the credit report with a fine-tooth comb. We're looking for any weird addresses or phone numbers or inquiries, but something random will come up. And then we start to run again. We kind of will get told what the closing date is. Unfortunately, you're also going to have that on your contract, and you're going to think this is the day that we're getting keys. It does move a little bit. From there, we're going to say, okay, the escrow company, that title company, they have the final figure that we need. We're going to wire it to them. You're going to talk to myself or directly to the escrow officer to find out where to wire it. You're not going to get anything in email because there are scams for that. And then you're going to sign paperwork at the escrow company, or they can send a notary to you. And then either same day or within 1 to 2 days, depending on which state you're in, you'll get keys to the home. So it kind of just goes like, we take off. We're like a rocket that's blasting for the first 3 days. And then within 10 days, you're freaking out. You're running all the inspections, crazy things. And then it slows down to the point where you're just like, no one's called me today. I usually get 7 phone calls a day. What's going wrong? It's almost like eerie. If you ever have any questions at all through the process, you just need to ask. We do try to warn you, hey, it's going to get quiet here for 7 to 10, 15 days. But we will be in touch if anything does come up. Really, at the end of the day, buying a home it's just kind of a crazy journey. It really is about you, unless you're buying a condo. Everything is going to be about you. It's going to be about your credit, about your debt, about your financials. It's going to be about the numbers that make sense to you. I just had someone today who said, hey, we have $100,000 in savings, and thank you for the numbers at $100,000 down versus $50,000 down. And she said, am I crazy for thinking that $50,000 down and having $50,000 as a cushion in the bank would be better for us? And I said, absolutely not. I said, if that's what helps you sleep at night, then that's what you do. Obviously, putting $10,000 more down is only saving you $63 a month. So if having an extra, $300 payment makes it more comfortable for you to have 50 grand in the bank, do it. There are things that we can look at. There are new construction homes that we can look at where we have to take a step back. We have a lot of people right now looking at new construction houses or wanting to do buy land and put a home on it. And we have to say, absolutely, those are options. Let's look at what that looks like. New construction is very deceiving because you really can't compare apples to oranges until you have the final purchase price, which includes going to their design center. And a lot of the times, those, the LVP, that luxury vinyl, some paint, maybe like the matte, washable matte paint, that's like a thing right now. Some molding, new light fixtures. I mean, those could be marked up 2, 3, 4, 5 times what they actually cost. So until you have that final purchase price based on your design center, we really can't even say, what does this look like? With anything newer, with any new home, new construction area, infrastructure that's new, we have to look at the property taxes. We have a lot of folks who are trying to move out of California. And when they compare Texas, which Texas is one of the larger ones that we look at, they go, well, property taxes are so much higher in Texas. And I'll compare and I'll say, hey, we're looking at this area in, Roseville, California, or Lincoln, California, someplace with more new construction, new property. And here's this home in Texas. Like we've got a lot of Williamsville, Liberty area, Texas. And we go, okay, the property taxes in California are 1.8% on this home, and they're 1.9% on this home in Texas, but they have no state income taxes there. So maybe you have different options depending on how you look at it. We have all these like stories that we tell ourselves based on what we see online. Oh, property taxes are higher here. Oh, gas is higher here. Oh, I need this credit score for this. I need this down payment for this. That we just talk ourselves out of things a lot of times. So if you have any questions at all, please just ask. We will be doing more homebuyer education as we get the questions that come up. We will be going over them and adding slides for them. We're trying to do a little bit more of like the short form content, the quick videos for them. So as I get questions, as I get like DMs and emails and texts and all the things, I'm going to be trying to make that into content. That way, that if you have a question, someone else probably has the exact same question. Again, you can schedule a 20-minute consultation anytime. I'm going to get this loaded to our the replay. So anyone who signed up can watch this on the replay as well. And yeah, if you have any questions right now, though, please let me know or DM them to me. I know I had a lot of DMs earlier, and we have some folks who are watching on the replay later tonight once I get this loaded. So I hope you all have a great evening, and we will do this again. I think we're going to do Tuesdays. So if you're looking for something more Tuesday, I feel like someone said, hey, Tuesday would be great. And then if I want to get pre-approved, I can get pre-approved over the next 2 or 3 days, and then I can shop for homes that weekend. And I was like, that sounds great. Absolutely. So thank you guys so much for hopping on, and I will talk to you guys soon. Bye, y'all.